As we head into the new trading week, we're looking at Beyond Meat, with U.S. markets currently closed for the weekend. Today is Sunday, November 16, 2025. The last trading session on Friday, November 14th, saw Beyond Meat close at $1.08 per share. That was a significant move, finishing the day up $0.070 or 6.93%. Now, if you just saw that 6.93% headline, you might think, okay, a nice little relief rally, maybe some good news. That is the expectation. But the reality of Friday's session is something entirely different. That $1.08 close doesn't even begin to tell the story. The real story is the volatility. On Friday, this stock traded in a range between a low of 94 cents and a high of $1.23. That is a massive intraday swing of over 31%. This wasn't a calm, orderly climb. It was an absolute knife fight on incredible volume, with 128 million shares changing hands. This isn't a stock anymore. It's a proxy war between warring financial theses. This isn't your stable Apple stock or a high-growth darling like Nvidia stock. This is a company on the brink, and the market is treating it as such. The common belief, the general expectation for Beyond Meat, is that this company is effectively finished. It was the poster child of the 2019 IPO boom, a company that was supposed to change how we eat, soaring to a peak of over $234 a share. Now, trading near $1, the narrative is that it's a failed experiment, a cash-burning furnace, and just a matter of time before it goes to zero. Another more recent expectation is that it's a meme stock, a short squeeze target just waiting to explode. But the reality is far more complex, and frankly, more interesting than either of those narratives. The meme stock story is largely a myth, one that trapped a lot of traders in October. And the "it's dead" story, while directionally accurate in terms of its growth prospects, misses the real battle being fought right now. This isn't a story about plant-based burgers anymore. This is a story about financial engineering, debt restructuring, and a desperate fight for survival. Let's start with what actually happened on Friday, the news that caused that 31% swing. It wasn't a new partnership. It wasn't a surprise earnings beat. It was a press release from the company announcing the initial conversion rate for its 7.00% convertible senior secured second lien PIK toggle notes due 2030. Now, that is a mouthful, and it's the kind of high finance maneuvering that most retail traders using a simple Robinhood app might gloss over. But this is the entire story. The company set the conversion price at approximately $1.7459 per share. This is all part of a massive, complicated debt exchange that the company has been executing to try and get out from under a mountain of 0% convertible notes that were due in 2027. They've been trying to swap that old debt for this new 2030 maturity debt. Why does this matter? Because Beyond Meat is running out of cash. The company's survival hinges on two things: stemming its operational losses and pushing its debt obligations further into the future. This debt exchange is its attempt at the second part. They are essentially telling bondholders, we can't pay you back in 2027. Please take this new debt that pays you a 7% coupon, is secured by our assets, and matures in 2030. In exchange, we get breathing room. The pop on Friday was likely a complex reaction to this news, with some seeing it as a successful step in buying more time, while the volatility shows the sheer uncertainty around whether it's enough. There is a special stockholder meeting scheduled for this upcoming Wednesday, November 19th, to vote for approvals related to this, which will be the next major catalyst. Until that vote, the company has to satisfy any conversions in cash, which is the one thing it can't afford to part with. This financial chess game is happening against the backdrop of a truly abysmal earnings report, which we got on November 10th. This is the reality that smashes the expectation of any recovery. For the third quarter of 2025, revenues were $70.2 million. That was down 13.3% from the same period last year. While it technically beat the very low analyst estimates, it confirms the core problem. People are buying less of their product. The U.S. retail business, the grocery store segment, was down 18.4%. U.S. food service was down 27.3%. The demand is collapsing. But the real headline was the loss. Beyond Meat posted a net loss of $110.7 million. That is not a typo. They lost $110.7 million on $70.2 million in sales. That is a staggering figure, far worse than the $26.6 million loss in the same quarter last year. Now, a huge chunk of that loss, about $77.4 million, was from non-cash impairment charges. This is an accounting move, but it's a devastating one. It means the company is officially admitting that its long-lived assets, its factories, its equipment, are not worth what they thought they were. They are writing down the value of their own business. They also booked a $1.7 million charge related to shutting down their operations in China. This is a full-scale retreat. This isn't a growth story, it's a story of contraction. And to make it all worse, their guidance for the fourth quarter was for revenue between $60 million and $65 million. This signals an even faster year-over-year decline than what we just saw in Q3. The cash burn is accelerating at the exact moment they need to conserve every penny. This is the kind of fundamental data that professional traders on the Interactive Brokers platform are looking at, and it's terrifying. This isn't a buy-the-dip situation. This is a will they have the lights on in 2027 situation. So this brings us back to that meme stock expectation. In late October, this stock went on a wild multi-day rally, soaring hundreds of percent. Social media was screaming that the short interest was over 100% of the float. It looked like a classic squeeze. But it was a trap based on dangerously bad information. The reality is that as part of this debt for equity exchange, Beyond Meat's share count exploded. It went from around 76 million shares outstanding to over 397 million shares. This massive dilution crushed the short interest as a percentage of the float. By the time the dust settled, the actual short interest was reported to be less than 14%. The squeeze was a phantom. Anyone piling in, perhaps using a SoFi Invest or Robinhood stock trading, thinking they were fighting the shorts, was actually just providing exit liquidity for the bondholders who were converting their debt to stock and dumping it on the open market. This is the danger of self-investing without doing the homework. People see a name they know, they see a chart that looks like Tesla stock in the early days, and they jump in. But the fundamentals couldn't be more different. Companies like Nvidia stock and Apple stock are backed by mountains of free cash flow and dominant market positions. Beyond Meat is backed by declining sales and a ticking clock on its debt. This is where getting good investment help is critical, whether it's through a human advisor or a managed solution like Schwab Intelligent Portfolios. An intelligent portfolio would likely never touch a stock this speculative. But for those managing their own individual brokerage account, whether it's at Fidelity, Schwab, or Interactive Brokers, this stock is the definition of high risk. It's a shame because the original promise was so compelling. Beyond Meat was founded to make plant-based meat substitutes that looked, cooked, and tasted like the real thing. Their goal was to appeal not just to vegans, but to meat eaters, focusing on the health, environmental, and animal welfare benefits. The IPO was a massive success, but the last few years have been a lesson in reality. The expectation was that the world would rapidly shift to plant-based options. The reality is that the products are expensive, competition from Impossible Foods and cheaper private label brands is intense, and a segment of the population has rejected the processed nature of the food. The company is still trying. They just announced new partnerships, putting their latest BYND Burger 4 into Hard Rock cafes. They've expanded distribution in Walmart and Kroger. But these are small wins in a losing war. The Q3 numbers prove that these distribution gains are not translating into sales. So what happens next? The future outlook is binary. In the bull case, the expectation is that this massive